Chapter 18 covers international finance, and one of the most important concepts in international finance is the balance of payments. The balance of payments measures money coming in from foreign countries and money that leaves to other countries. All this money that comes in is considered a plus or a credit, and money that leaves is considered a minus or a debit. The balance of payments adds the positives and the negatives and all the negatives, and this is supposed to be equal to 0. That's why it's called the balance of payments. It has to be balanced. Well, the first part of the balance of payments is the current account. In the current account, we add all the exports and subtract the imports. These are merchandise exports and merchandise imports. Add the two. Remember, exports are positive, imports are negative. Add the two, you get merchandise trade balance, which is negative, or was negative for 2012. In other words, we imported more than we exported. Then service exports plus 649, service imports minus 442, and if you look at these two numbers, we have a positive difference between the two because we exported more services than we imported. However, there's a balance of goods and services, and that is when you add the merchandise trade balance and the balance of the services, which is item 4 and 5 here. So we get a minus 534.7. In other words, in terms of both goods and services, we bought more from abroad than we sold to foreigners. Remember to watch the video of Milton Friedman. It's a very valuable video. Some people see this as a negative thing, but using simple language, exports are used to finance imports. If we sell $100 worth of goods and services to receive $120 goods and services, well, that's not a bad deal. Think about it and watch a video. Now, net investment income abroad. That's another item. What is that? Well, when you purchase, let's say, a bond, but it is a German bond, then you buy an asset. So a U.S. person purchasing a German bond, that means money will leave. However, later you're going to get an interest rate or coupon rate from the bond, and that is money that comes in. That is investment income. You can also think in terms of buying a house in Japan, and then you get rental income from the house. So that will be part of the investment income in the current account. So that is part of number 7 here. Income that comes from investing abroad. However, there is also income that foreigners get paid from the U.S. firms or U.S. government for their investments, or from U.S. individuals too. Okay? So because this includes all the interactions of goods and services between individuals and firms and governments. Now, item number 8 is net unilateral transfers. Unilateral transfers is when the government or individuals in a country transfer money to other individuals, government, or firms. For the most popular unilateral transfers is what is called the remittances. This is when individuals transfer money from their accounts here, let's say in the United States, to their home countries. For example, somebody who comes from Mexico to work in the United States, and then they send money to their relatives in Mexico. That is a unilateral transfer or remittance. And this money obviously leaves the United States, so that is a negative. But when we receive money from abroad, then that is a positive. Notice that it's negative here. That means that we sent more money than we received. Finally, the current account is just a summation of 6 and 7 and 8. 6 is our previous balance of goods and services. Then we add net investment income and net unilateral transfers, and we get a negative 440.5. Now the next account is a financial account, also called the capital account. This one measures the amount of money that we pay to purchase assets and the amount of money that we receive from foreigners when they purchase our assets. So we have here a change in U.S. owned assets abroad, negative 97.5. Change in foreign owned assets in the United States, plus 543.9. So this is, remember, if we buy an asset abroad, that is negative because the money leaves, it's negative. But when foreigners purchase our assets, that's a positive, so that's 543.9. Add the two and you get the financial account balance or the capital account balance, plus 446.4. Now this number is expected to be the same as this one, as I told you before. However, there's a difference, and that difference is plus 5.9 if you notice. So that's why we need to make the statistical discrepancy adjustment and subtract 5.9 so that when we add 9 and 12 and 13, which is this balance, and then this 2, we get the 0 here. Now notice that we have negative numbers here. That means we imported in value more than we exported. Well, that means foreigners have, let's say, more money or dollars. And what do they do with this money? Well, they turn around and purchase our assets. They buy our bonds, our stocks, our homes, or plants, buildings, etc. So that means we receive money. So that's why we have this plus 543.9 here. And as a result, every time we have a negative here, it is translated to a positive here. And then this number is expected to be close to this. And the final statistical discrepancy is made so that the balance of payment will be balanced, or balance of payments will be balanced.